My $1 million TQQ mistake wasn't about missing the opportunity. It was about realizing I wasn't prepared to survive the wild ride. It was a systems failure. After more than 20 years in the market, I've learned that having a profit protecting process is critical. In this video, I'm showing you the 3 tools we can use to survive the painful drawdowns that wipe most people out, and the exact action zone to buy TQQ. Let's get to the charts. Since inception, TQQQ has had multiple times where it has had drawdowns of 40% or more. And so these are the destructive times we're talking about, where bam, you're riding along, and then it just knocks the wind out of your sails. Check this out. Just in the past recent years, we've had 40%, 50%, and even an 80% drawdown. If you're a buy and holder, seeing your account reduced by that much, at least on paper, would be something that would cause a lot of pain. Every one of these drawdowns tested whether a trader had a real process for survival. You got to remember, you get a 50% drawdown, it takes you 100% to gain it back. If you get an 80% drawdown, it requires 400% gain just to get back to break even. And that's why protecting capital matters so much. The deeper the drawdown, the harder the recovery math becomes. But imagine having a flight plan that would help reduce the crushing effect of these drawdowns by even 50%. The following tactics will help do that. So let's check that out next. Okay, so when do we shift to defense? Well, check this out on the chart. Typically, what I'm looking for is a couple of different things. Is one, I've basically run up after a nice long uptrend like this, and then I start a topping process. I'm looking for a couple of things. I'm looking for divergence on my TSI, and then also on my weekly, this is a weekly chart we're looking at, my weekly at MACD, also the histogram starts to go down. I cross below this equivalent to the 50-day moving average. I break a level of support, and that gives me the clue I am now in the defensive mode. So what do? Well, the first tactic we can utilize is simply to start hedging. How do we do that? Well, first, tactic number 1 is we look at buying SQQQ. What did SQQ do during this same time frame? If we bought SQQ when TQQ broke down about here, it provided a nice little run up of about 102%. That would definitely help protect, give us a hedge to the downside. The trick on trading SQQQ is that if I bought $3,500 worth of TQQQ, I want to also buy $3,500 worth of SQQQ. How well did this do in the long run? It protected over 60% of the drawdown that was with TQQQ. So that's tactic number 1. What about tactic number 2? Tactic number 2 is to buy put insurance as we drop down. Here's where I would have triggered in with a put. Now, what I'm looking at is to buy a put that is approximately 6 months to even a put leap out there, approximately at the money. That way, as TQQ fell, that put would be increasing in value. This was our second most costly approach. It covered about 50 to 55% of the drawdown, as you see, all the way to the bottom. So on this drawdown, it took 364 days. So a leap that was out there a year, it would have done very well as TQQ continued to decline. But what about, is there one more tactic? Yes, there is. Let's check that out. Tactic number 3 is just to do a covered call strategy, but not just any covered call strategy. We want to be looking at selling weekly calls that are approximately at or in the money as we've started to fall down. So, how do we time that? And I'll just give you a real quick clue on that. If a video showing exactly how to set up these three tactics would help, let me know in the comments and I'll put that video together. How does it work? Well, this is a weekly chart. As we start to drop, I look for opportunities to sell on a weekly basis. How much do I try to collect in a premium? I try to collect $3.50. And where do I try to sell it? Once TQQ starts to drop, I look for any pullback up towards the 50-day moving average, as represented here by the 10-week moving average. You try to return up to there to sell the position. So I'd be looking at selling here. I look at it being selling here. And as I said, weekly covered calls that are about 1 week out. And the move of TQQ to the downside, I'm getting about $7 to $8 worth of move during this time on a weekly basis. So pulling out 250 to 350 out of a covered call is reasonable. Okay, the goals of these three tactics is the same. Protect the compounding engine that is TQQQ, because long-term wealth is built by surviving the resets that destroy most traders. Now, before we look at the results of hedging, a critical note. This is a hypothetical back-tested scenario. Past performance never guarantees future results, and leveraged ETFs carry significant risk, including the loss of all principal. This is for educational logic, not a promise of potential returns. Hey, with these tools applied, that same $3,500 we started with has the potential to grow well past $1 million over the 16 years since inception. And in this case, just offsetting 50% of the drawdown would have improved our compounding up to about $4.6 million. The difference is simple. We defended the principle so that the math could keep working rather than bailing out or ejecting out of TQQQ. If this trading structure makes more sense than emotional guessing, hit subscribe. We do these market debriefs every week. So let's bounce next to zero in on when the heck is the most opportune time to be buying TQQQ. I like to keep my eye on the weekly chart. So what am I looking for? Well, I want to make sure that a couple of things are happening. One, I've had a significant drop or pullback. We see multiples of those along the way. I also want to be looking at my momentum. What's my momentum telling me? In this case, my TSI has bottomed and is starting to move back up. And the real telltale is the MACD histogram that is also reversed and started to move back up. Note, we have a bottom. We get a reversal signal on the candlestick, a bullish engulfing, and then from there, away we go. If I miss this opportunity right there, I would look at my break above the 50-day moving average and then use that as my secondary entry. We see that here. We see a here, however, while my MACD has started to move up, I was still falling because I was way below the 50-day moving average. However, then it starts to shape up. What do I have when I hit the absolute low? I have positive divergence. My MACD has started to turn back up. And from there, it just continued to run up. Even the pullback back in 2025, we get the same pattern. So if I'm looking, keep your eye out for those really extended TSIs and the MACD histogram starting to turn up. So I hope that helps you target in on where I like to enter. This is where structure matters. We're not blindly buying weakness. We're waiting for objective conditions that suggest institutional momentum is stabilizing. That's the difference between reacting emotionally and operating with a flight plan. If you are a busy professional who wants a routine like this delivered to you every Sunday so you could be ready to trade on Monday, check out the link for our Leverage ETF service. It's in the description. And for more proven swing trading insights, watch the full masterclass next to see how we apply this swing trading in a live market.